This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. You can get used to my face a little bit, as most of you probably know. Scott is going to be in Ukraine until next Wednesday, going over there and teaching some traders, doing some educational stuff over there, as well as seeing whatever sites there are in Kiev, Ukraine. So you're going to get used to my face. You're going to get used to seeing the faces of some of the other T3 Live contributors over the next week or so. So hopefully, we don't miss Scott too much, and hopefully you find some value in the perspective of some other voices that are going to be shared from T3 Live. So getting to today's market action, obviously a day of carnage, especially in tech in the market today, is also the S&P broke below a key level, but that wasn't really the most compelling story of the day. It was the widespread, like I used the word carnage, I think that's the best way to describe it, the real harsh downside we saw in tech stocks today. And it almost seems very calculated. You hate to speculate about market manipulation and things like that, but they kept tech, the composure in tech, very strong for so long, and not only in tech, also in biotech stocks. But they kept composure so strong in those two areas specifically, and then in one day, in one fell swoop, they come in and absolutely just wreck it. And there was nothing really that came out today that was negative for tech, negative for the tech sector. It's just something that I think it's the mechanics of the market, whether boxes recognized something that happened or they lulled people to sleep enough that this was the most strategic opportunity for them to come in and whack tech. But just interesting to note that today and something to be aware of. It's sort of, if you follow me on Twitter, you saw today I talked about how everything's rosy in the market till it isn't. That's a little bit of a blanket statement, but you can never be lulled to sleep. Everybody tends to fall victim to the recency bias. It's a classic heuristic where everybody remembers basically what was in the recent past as opposed to what happened maybe years ago. And there was a quote today, I think he was speaking at a conference, Byron Wien, a popular financier, talked about how generally our government and our society finds a way to avoid disasters, but that would sort of go against what we saw 5 years ago and what we've seen at various points during the cycle of our economy, of our stock market over the course of, we're talking 100 years. So I think we can be lulled to sleep by the uptrend we've seen in 2013 and lulled to sleep by the resilience of the market, but you always have to remember, not to put fear into anyone, but you always have to remember what can happen if things get a little bit out of hand. And I think it was natural to see the market go up in 2013, especially given the monetary policy we've seen from the Fed. But in general, I think things have gotten a little bit overdone, and that seems to be a consensus opinion right now from even the most reasonable analysts and technicians and things like that. So I think it was natural to see prices correct a little bit, but the way it happened, I don't think it's healthy to see high-profile stocks in the stock market dropping 5–10% in one day. We've sort of been desensitized to volatility in the market this year, and even foreign markets are even more volatile. And I think we've been desensitized to it a little bit so we don't react in the same way that we might have in the past, but I think it's not a healthy way for a stock market to operate. And that's the end of my rant. We'll go take a look at the chart of the spiders, or the S&P. As you can see, we broke below that key 1660 level on the S&P that we've been watching as a level that composure could change, and today definitely marks a change in composure in the market as we close just below the 100-day moving average and just below this trend that's been intact since that well-publicized November 2012 reversal, or even more specifically the uptrend. As you can see, the uptrend is drawn here from the November reversal that we've held multiple times over the course of this year, but now we're just piercing below it. So the key will be whether on a weekly chart, whether we close below that trend line or whether we're able to get back above it with some sort of snapback tomorrow. But overall, definitely big composure change in the S&P, but that pales in comparison to the composure change we got in the Qs, the NASDAQ ETF. Go back to the daily chart there. As you can see, like I said, really harsh downside action today that sort of came out of nowhere. From a fundamental perspective, it didn't come out of nowhere because some of the valuations on these tech stocks have gotten completely out of hand. But for it all to come crashing down in one day, I think is a little bit sketchy to me. But as you can see, wide range down bar, you have to respect it. Now retesting the prior breakout level that we broke above back in early September. So something to keep an eye on there, whether we bounce off the 100-day moving average or not. But when you see harsh downside action like this, it's not a good sign. Yes, we could bounce off of it. We could recover from it. Resilience has been the name of the game in 2013 for the market. But when you see harsh down moves, sometimes it can lead to further downside. So something definitely to keep an eye on. And then I'll take a look at the chart of the VIX. Not something we really have paid attention to much this year. It's just been bleeding lower, as the VIX is a flawed instrument. Rob Smith will tell you about that. He sits short the VXX in the T3 Live VTF because, as I said, it's a flawed vehicle that's made to go to zero. So it seems over the long term, if you can consistently short the VIX on bounces, you could potentially put yourself in a strong position. But as you can see over the last couple weeks, as this government shutdown, debt ceiling stuff has crept into the headlines more, you've seen the VIX really start to turn up and accelerate higher. Over the last 2 days, you've seen an acceleration in the VIX. The VXX is coming into a key resistance level now, and I don't think you can ever really go wrong shorting the VIX into spikes. I know obviously everything is very contingent on whether or not we default. October 17th is the deadline for the debt ceiling. These negotiations in Washington get increasingly humorous, I guess you could say. It's not funny, I guess, if you have money in the stock market, but both sides are sort of digging in their heels, unwilling to negotiate. Most people think that there's no chance that we actually default. I think both sides recognize that that's sort of a mutually assured destruction, that it's not good for anyone if we default, and using that as a negotiating tool is a little bit disingenuous. I think both sides understand that to a certain degree. But there are more and more voices coming out now that think that default is actually a real possibility, because you're seeing the president very unwilling to negotiate at all, and Republicans obviously rebuking that unwillingness to negotiate. So it's something that I think more people think that it's a possibility, but I really don't think it's a possibility. I think the parties will come together and figure something out ahead of that debt ceiling deadline, and I think shorting the VIX on any major spikes like you saw today, I think it's a sound strategy. But after being dormant for so long, sometimes this volcano can erupt a little bit, so definitely always have your risk management in place for any type of trade like that. But going further into depth about the carnage in tech land today, I'll just run through symbols. I was trying to tweet out some symbols today of stocks that got absolutely decimated, and people said, oh, but this stock went down too, and this stock went down too. I ran out of room in 140 characters that you're allowed on Twitter. I couldn't even fit probably all the symbols that got absolutely whacked today in tech land, so I'll point out a few of the more notable ones. LinkedIn was obviously near the top of that list. A huge down move today. Finished down over 6% despite the fact that it closed off the lows. It almost filled this gap all the way from late August, engulfing multi-month price action. So obviously a day to take notice there in LinkedIn. And I'll go through a couple more stocks that support this notion too, but some people think that perhaps hedge funds and things like that are freeing up capital they allocate to new media, social media type stuff. They're freeing up some capital to buy Twitter and maybe dumping some LinkedIn and dumping a stock like Yelp. Yelp also potent down move today, as you can see on the chart, down over 7%. It's not healthy to see stocks, high profile stocks drop 7-8% in one day, but that's neither here nor there. As you can see now, it's below the 8-day and 21-day moving average, engulfed multiple weeks of price action. Given the valuation of this stock and given where it's come from, the context of the move, not really a big deal. But you can't really shrug at a 7-8% down move in one day. As we always say, any harsh move in one direction can generally lead to more movement in that direction. So I wouldn't be surprised to see more downside correction from Yelp. Perhaps hedge funds are dumping it for Twitter also, like I mentioned before. Pandora, another one that I'm really not a fan of. If you follow me on Twitter, you know that as well. I talked about when it was originally trading up here around 27, the new Apple iOS update came out, iTunes Radio became available, more readily available, and a lot of people were using it and giving it very positive reviews. And just anecdotally, that led to a huge 11% down move on this day, September 23rd, in Pandora. It was very impressive to see Pandora bounce back to highs, but it's put in sort of a double top after that breakout failure. And then today, obviously, a huge harsh down move, finished down almost 8%. Again, also, despite closing off its lows. Facebook is one that did have a harsh down move today, but one that I am a little bit more bullish on than some of those other names, those speculative social media, new media names. Facebook is one that, yes, harsh down move today, broke below its 21-day and its 8-day, broke below its 21-day or even tested its 21-day for the first time since that big earnings gap and go. So definitely something to take notice of, but I would consider it more of a buying opportunity in Facebook than I would in some of these other stocks that saw harsh down moves just based on the strength that it's had since that earnings gap and go. Something that I'll definitely be keeping an eye on for potential dip buying opportunities. Amazon. I'll be a little bit quicker about the rest of these. Amazon, big harsh down move today. Google, obviously harsh down move, coming close to testing this major support level here below 850. Apple's another one that had a harsh down move, but in the context of the chart actually held up reasonably well. Closed just below its 21-day moving average. Didn't engulf multiple weeks of price action like you saw a few other stocks do. And I think Apple is still in the game for higher prices as long as it can hold this pivot here. This pivot low is around 474. So as long as Apple can hold that pivot, I think you could still potentially see a bounce, a potential break of this downtrend that's been in place since mid-August. A few other names. Zillow's another one that I like. It's had a more significant pull-in, a more calculated pull-in rather than all happening in one day. It did have a secondary offering that it shrugged off a month and a half or so ago, or a few weeks ago. And this is one that coming down into its 100-day moving average I think could potentially be viable. I like the product. I like the website. I like everything that it offers. I think it has much more potential long-term than something like a Pandora, just to provide a little contrast on two stocks like that. And you also saw Chinese internet stocks really get whacked today. It's another group that's been really strong in the market. You see that move in Sohu. I mean, obviously it had a very impressive run in September, but really harsh down move there, engulfed a few days of price action back below its 8-day that's now curling down. So I think you could see some choppy action, maybe some further downside correction in stock like Sohu. Sina also punished today, but Sina is one that is still holding that upper level base. You know, you look at these percentage moves of 5, 6, 7% down at some of these stocks, but then you also have to look at the context of the recent chart. Just like it's not healthy to see 5, 6, 7% down moves, maybe it's not healthy to see some of these stocks that aren't even really making money yet having these huge speculative run-ups despite the fundamentals not supporting the price. So you have to look at the moves in the context of the chart to see whether or not it could potentially still be a healthy setup. And Sina is one that I think could potentially find some footing at the 50-day, at the support from that upper channel. So something to keep an eye on. Also talk about how biotechs got punished today. It's basically where all the strength was hiding in tech and biotech stocks, and then in one fell swoop, like I talked about earlier, it all came crashing down today. You look at IBB, which is the biotech ETF, huge harsh down move today. To see a move like this in a sector ETF, not healthy again. You know, the 8 and 21 day sort of came under threat yesterday as we closed below the 8-day and right at the 21 day, but then a huge acceleration lower, broke below the previous breakout level for the IBB, so definitely a day to take notice there. And action like this can lead to some choppiness on a short-term basis, but on a longer-term basis it can definitely lead to more downside continuation as a major uptrend was broken as well. You zoom out to the weekly chart to get a better look. That accelerated uptrend that's been in place since this summer broke on IBB, so it'll be key to see whether on a weekly chart IBB can close back above that accelerated uptrend. And just a couple examples of stocks in the biotech sector that got punished today. BIIB had that harsh down move back on October 3rd, 2 days of trying to reclaim some of that igniting bar to the downside. But then the 8 and 21 day caught up after a couple days of rest. And then it obviously today had a really harsh down move down into the 50-day. So something to keep an eye on there, whether BIIB can hold the 50 and 100-day moving average. If not, it could definitely go down and test this support level around the 205 area. Alexion, another really strong biotech stock, harsh down move today, but it's another one that in the context of its chart, yes, it did engulf, multiple weeks of price action, but it still has some pivot support here, still has the 100-day above it, didn't completely fall off a cliff. So, I wouldn't be rushing to buy a stock like this, and biotech in general looks like it's going to be broken for at least a short period of time, if not, if this isn't even a bigger complexion change. But something to keep an eye on. Alexion's been something that's been really strong in the market, but something that right now I think should be a little bit further off your radar, if not completely off the radar. A few stocks that actually, on a day like this, you take note of the carnage and you look at maybe at some extreme drops that you might want to buy, companies that you like, companies that are on your shopping list. But you also look at stocks that held up well today, because these are stocks that maybe have some pent-up energy but couldn't release it given the market headwinds that we saw from the broader indices today. And one example of that is Solar City, one that we listed last week on our Off the Charts, a really timely setup. We listed it on Wednesday, October 3rd. The next 2 days, it got really impressive price action, and then today extended above this pivot, which we talked about as potential resistance. Yes, it did get a really wide range. You don't really like to see a wide travel range like that in a stock, but given the market's extreme weakness and the fact that Solar City closed positive, a doji candlestick is a candlestick of indecision. It tells you basically that it's you should be in wait and see mode a little bit, but it's definitely not game over for a stock. And Solar City looks like one that wants to go higher. And if the market can find its footing, I would imagine Solar City could be one that continues to the upside, like it wanted to early in today's session, but just couldn't overcome that broad market weakness. Whole Foods, another one that we highlighted last night and Off the Charts. Yes, you don't like to see a breakout failure, but you also have to judge that breakout failure in the context of the broad market action today, like I talked about with Solar City. It actually closed positive or right near the flat line into the close, did Whole Foods market. So given the broad market weakness, I think you have to give it a little bit benefit of the doubt here. And I think this setup, as long as it can hold, especially above the 8-day, I mean, extremely bullish to see a stock holding above the 8-day in this type of environment. But the 21-day, even if it can hold that upper level channel, I think Whole Foods will remain a very compelling long setup, and we'll continue to list it in Off the Charts. Lululemon, another one. Not a market leader, but recently it has been acting as one of the market leaders, one of the stronger stocks in the market. We also highlighted this out of this descending bull flag type pattern in Off the Charts. Today, obviously a harsh down move, but it did hold its 21-day. So another thing to potentially keep an eye on to see if it can bounce when the market firms up a little bit. And SanDisk, another one that we talked about in Off the Charts that just broke below its 8-day, still well above its 21-day. That's the type of relative strength we like to see. So another one to potentially keep an eye on if the market does firm up. And then another thing to note is we really saw a classic flight to safety today. We saw a flight out of tech stocks, out of biotech stocks. Those are more speculative type sectors. And we saw the utilities. We saw consumer staples. Gold tried to hold up, but that's a whole other story of gold being an absolute dog. But you saw those safety sectors in the equity markets actually hold up pretty well and actually close positive. Look at the XLU. XLU was up around 1% today. It closed well off its high, so it probably closed down less than 1% based on the last time I checked it. I don't think this is a trend that's going to continue. We're in a rising interest rate environment. That's negative for defensive sectors like utilities, but it's one that did show some relative strength today. Could get a short-term bounce. It's not one that I would be putting back in the drawer. I wouldn't be looking to buy utility stocks in this type of environment. That's more of a counter trend type trade. But just something to take note of, that leading up these next 8 days up until this debt ceiling deadline, you could see a flight to safety type stocks, safety type sectors like the XLU. XLP is the same way. XLP has been punished over the last few weeks, but today actually finished narrowly positive, so another sign that there's a flight to safety. And gold tried to bounce. Everybody thought with all this turmoil in the market, gold should bounce, but the fact that it couldn't is a really, really bearish sign. And I know a few people in the VTF were looking to short gold. I think Mark Sperling bought some gold puts. But it's, when the market's in turmoil like it is today, and you have a potential default on U.S. debt, and the way that would impact the dollar, the fact that gold couldn't bounce, I'll repeat it again, extremely bearish sign. I think gold will probably go back and could test these recent pivot lows here around 124. And beyond that, it's lookout below. And on a long-term basis, I'm not bullish at all on gold. But that'll do it for today's pretty comprehensive daily recap. Sorry if I was a little bit long-winded. But like I said, look forward to seeing my face a little bit over the next few days, over the next week. I did get myself stuck in jury duty, so you'll see me more in the mornings than you will in the afternoons. But I think it'll be a really good change of pace. I know we'll all miss Scott's analysis and Scott's approach to the market, but you'll get to see a little bit more from other members of the T3 Live team, other T3 Live contributors that are really talented individuals that bring a little different perspective, and I think it'll definitely open your eyes to some other ways to approach the market. Look forward to that over the next week or so. This has been John Darsie, your editor-in-chief, here for the Daily Recap. We'll see you back here for the morning call tomorrow morning with Brittany.